morning, afternoon, or evening for you, is hosted by Public Service International. And I'd like to invite Kate Lappin from Regional Secretary for Public Service International Asia Pacific to share a few opening remarks about these expansions on financializations as well as the push for privatizations in almost every sectors these days, including in public sector, as well as relevant for the workers in the regions and PSI's engagements in challenging this development. Over to you, Kate. Thank you.
Thank you, Kartini. And good evening, good afternoon, comrades. It's good to see many familiar faces here. I think many of us know each other and have been working together for a number of years in the struggle against, particularly against corporate power. I'm not going to take too long. I just wanted to give some opening comments around why this work is important for us and why I think we need to build a collective efforts to really challenge the growing influence of the billionaire class, of private investors and corporations. And this is certainly something that is part of PSI's priorities. And we'll be focusing increasingly on our capacity to fight back against the billionaire class and private equity. So pension funds and or vulture funds, as the topic is highlighted, are increasingly part of the landscape of privatising public services. And of course, the fight against privatisation is important for all PSI's affiliates across Asia Pacific and across the world. And we think that, I'm sure many people have heard the expression that sunlight is the best disinfectant. And if we're going to challenge the way in which private corporations and capital have been influencing governments, have been undermining our democracy and undermining our public services, we really need to expose their model and the methods in which they have been able to capture policy space and governments so that they can increasingly have a footprint in public infrastructure, public services, but as Green has also highlighted in food, the process of food and agriculture. And that's why PSI is very pleased to be part of the work that CICTAR has done and we'll be talking about today, but also wanting to build the capacity of our affiliates to campaign together with organisations like CICTAR and Grain to match our industrial campaigns with these campaigns that expose the corporate model. And of course, it's really a rapidly changing space. I think we now have private equity holds something like $13 trillion in assets, and that's double what it was, I think, 8 years ago. And that's often couched as infrastructure investment, and we're even within our sustainable development goals and other development speak, we hear about this as part of a development model, but it's actually code for privatising public service and core part of the services that we own as workers and as the public. We've seen this across our region. We've seen that some of the work that CICTAR has done to expose, I think it's some 3.5 billion now in private aged care assets that are held by private equity or investment funds. But we've also seen that in India, some work that PSI did to look at the way in which sovereign wealth funds and other equity investments have entered into private health, and that's often backed by the international financial institutions and often as part of loans and grants that came as a result of during and after COVID. So in fact, the expansion of privatised public services has often been with public money from other countries, but advancing private wealth. But part of, I think, the major concern around this is that much of this is our money. It's our workers' pension funds. It's what we might call workers' capital. Globally, there's something like 56 trillion US dollars in pension funds. And so that's one of the largest institutional investors in the world. And we often, very rarely, have a meaningful say in the way in which that investment is actually used. And so our own money, our workers' funds, can be used to undermine public services, to commercialise care or to cut jobs, um, and to use the narrative of profits to justify precarious work and undermining wages and conditions. So it's really not only an issue of where private finance is going, but it's a question of where our own funds are. What power do we have as the labour movement to make, to democratise our own funding, but also the decisions that governments make. So we've been part of the global movement to insist on transparency measures so we better understand what these corporations are doing, and that governments should be implementing a range of reporting and transparency measures, whether that be in the important developments in tax reporting that have been achieved here in Australia with the support, with the campaigning power of CICTAR and our affiliates. We've got some of the best laws on what we call public country by country reporting that allows for not just where these corporations are holding their capital or how they're avoiding taxes, but also where workers are and where their economic activity is. We also need to know exactly who owns these corporations, who's benefiting from it. So there's a range of those rules that we are insisting on and having some success as we go. And I think hoping to expand that further in our region. So I'm looking forward to the presentations today and the discussion, and really invite those of you who are members of PSI to continue this conversation around how we match up this work with some of our campaigning and our industrial demands, and perhaps to follow the conversation at our regional conference later this year in September. Thank you, and yeah, looking forward to the discussion.
Thanks a lot, Kate. I think it's interesting the way you mentioned how nowadays public money are being used to even undermine public services, and also including the worker situations. So we will start further going deep into these discussions today, and I would like to invite Devlin Kuyek, who's a researcher at GRAIN, to share an overview of these various key trends in financializations, as well as implications with the examples of the regional food system. Time is yours, Devlin.
Am I on mute? No, I'm good. Okay, thank you, Kartini, and thanks so much, Kate. That was fantastic introduction to today's conversation, and covers quite a bit actually of what I would like to present. So GRAIN is going to just give an overview of some of the actors that we're talking about: private equity funds, pension funds, development banks, and sovereign wealth funds. And then some discussion about strategies and actions to deal with them. And I'm going to start with just going through a couple of examples that have emerged from our own work on looking at these companies. So in 2008, after the food and financial crises of that time, we started seeing a surge in land grabbing in Brazil's Savannah region in the northeast of the country, in an area called the Cerrado. And many traditional communities were being violently and illegally displaced, and there were large swaths of lands were being cleared and deforested by local businessmen to make way for massive industrial farms to produce soybeans for export. But it was very hard to say where all the money was coming from, and we knew there had to be lots of money coming from somewhere. And so through time, investigations sort of pulled back the curtain, and it turned out that these local companies running things on the ground were just fronts for a complex structure of companies that extended through tax havens, like the Cayman Islands, and ultimately connected with the real owners, who were pension funds and university endowments in the US, Canada, and Europe. In fact, one teacher's pension fund in the US and Harvard University's $50 billion endowment had in fact become two of the biggest farmland owners in Brazil, funding a massive expansion in industrial chemical agriculture in the territories of traditional and indigenous communities. A few years later, we started seeing other companies buying up or renting lands in highly water-stressed parts of the world to produce high-value crops for exports that require huge quantities of water. So they were essentially growing crops like blueberries, strawberries, avocados, as a way to convert cheap access to water and land, and of course cheap access to labor, and convert that into money. And they didn't care if they were doing was depleting the water sources. Their strategy was just to pump out as much water, produce as many crops as you can until the water runs out, and then pack up and move to another location. And here too, the money behind these companies was coming from distant financial players with names like Renewable Resources Group or the Abu Dhabi Development Holding Company. And for financial companies like these, buying up farmland and water gives them an opportunity to make profits outside of the usual investments in stocks and bonds. It's a big part of why they're doing it. It's a hedge against market volatility. And it's also a way to profit off essential things like land and water that increase in value because the demand and our willingness to pay for them never diminishes. And that's why you see the same situation when you look at other crucial segments of our economy, like in the food system. Several sovereign wealth funds from the Gulf countries now have controlling stakes in some of the world's largest grain and meat companies. If you look at infrastructure and energy, you'll find Wall Street equity firms and Canadian pension funds with their hands on everything from dams and water utilities and ports to telecommunication towers. Just as an example, 2 Canadian pension funds are now the largest owners of toll roads in India. And if you're using a cell phone in Indonesia, chances are you're paying something into Australia's biggest private equity fund, Macquarie. They're also investing in healthcare and education, and Ed's going to talk about this. Kate has already mentioned this. And housing. US private equity firm Blackstone is now the largest rental landlord in the US and the second largest in Spain. These types of investments are called alternative within the financial world because they provide an alternative, as I was saying, to stocks and bonds, the traditional investments. And they're private investments because they're not traded on public markets like stock markets. It's direct. And as Kate was saying, this makes it so that it's very hard to know much about these companies, what they're buying, and who's investing in them. Now, there's a few charts here. And if you look at the one on the top left, you'll see how the growth in investments in these alternatives in the private market is vastly outpacing the growth in investments in stocks and bonds over the last 25 years or so. At the bottom left in the pie chart, you can see that section in orange. And what that shows is that of all this money that's moving into private markets, a big chunk of it, over a third of it, is being channeled through private equity funds. And then on the right, what you see is just this increase, this massive increase in money that's going into private equity funds, especially over the last 10 years. So just a little on what is a private equity fund? So we put together a little graphic, an information graphic about private equity funds in agribusiness, but it really applies equally to other sectors. A private equity firm, whether they're in London or New York or Singapore, will create a fund registered in a tax haven, and they'll put in a minimal amount of their own money. And then they'll bring in funds from institutional investors. So these are public pension funds, these are sovereign wealth funds, these are billionaire trust funds, these are development banks like, say, the Asia Development Bank. And then with that pile of cash, they go out shopping and they buy up companies and assets, in this case, farmland around the world. And then they often use these assets as collateral to borrow more money and buy up more companies. And then within a very short time span, just 10 to 15 years normally, they try to sell out all of these companies and the assets, and then distribute the profits from these sales back to the original investors while keeping a significant portion within the private equity firm. And that private equity firm actually charges fees throughout the existence of that private equity fund. So it's hugely lucrative for the private equity firms, which have become known as billionaire factories because of all the billionaires that they're creating, while the actual profitability for the investors is a little bit more debatable. By far the largest source of money for these private equity funds are public pensions and sovereign wealth funds. They account for a whopping 70% of all the funds in the private market. Okay, so that's even beyond just private equity funds, but they are by far the biggest player. So when we're talking, as Kate said, when we're talking about whose money it is, it's pretty clear. So what do we mean by public pension funds? Well, these are funds that manage the retirement savings of workers, which are really just the deferred wages of workers, right? And it's not for all workers. It's a segment of the workforce, and there are actually very few workers globally who have access to a pension fund, and even fewer who have access to one of these types of public pension funds. 7 countries, Australia, Canada, Japan, Netherlands, Switzerland, UK, and US, account for over 92% of all the assets that are held by these public pension funds. And they are run like financial companies. There's really no worker oversight or involvement, and they have an exclusive focus on profit maximization. I mean, you can forget any social criteria. And they've been increasing their investments in alternatives and private equity, and even through their own investment teams over the years. And there's a constant effort to try to push more pension funds towards a financialized structure. And this happened recently in Thailand, where Thailand loosened regulations to allow its public pension funds to invest in private equity and alternatives. Sovereign wealth funds are set up by governments and are supposed to be a way to look after the wealth that comes from an excess of public resources. It can be copper in Chile, oil in Saudi Arabia. And they're supposed to serve a public interest objective. So Norway's sovereign wealth fund, which is based on oil revenues, finances the national pension plan, for instance. But over the past 2 decades, as you can see in the chart at the bottom, the number of sovereign wealth funds has surged, and there are more than 100 of them. But increasingly, that excess wealth and that public interest sort of angle to it has disappeared, as you'll see in the case of the Philippines, which Sunny's going to talk about. And then there are a third set of actors, which Kate also mentioned. And these are the development banks, or DFIs or IFIs, however you want to call them. And they're quasi-public bodies that operate on a for-profit basis. So some examples are multilateral ones like the World Bank's IFC, There are national ones like the Vietnam Development Bank. Some have a foreign focus like the Dutch FMO, and some target both foreign and domestic investments like the China Development Bank. Now they are supposed to finance things or make investments in things that are seen as too risky for private banks, but that have a public policy objective, like say building bridges. But a lot of their money is now going into private equity, and it's particularly important for private equity funds who are focused on the global south. So why is all of this a concern? Well, we want to highlight two sort of overarching problems with this movement of what is essentially public money into the hands of these private financial players. One, which Kate has already said, is privatization, right? So the growing power and money that are in the hands of these financial companies increases the conversion of public services like healthcare into for-profit structures. And it's the same with infrastructure, whether it's toll roads, trains, or energy. And public goods too, like water. A lot of private equity funds are invested in water privatization. With land, these companies are driving a violent conversion of public and common lands into private assets that can be traded on global markets. The second overarching issue is financialization. So these are financial companies, right? And they're bound by a logic of short-term profit maximization. And they maximize their profits by using strategies like leverage, mass layoffs, tax evasion, asset stripping, so taking profitable, maybe even unionized companies and selling them off in pieces to put money in the pockets of their managers and investors, and mergers and acquisitions, right? This is a big thing they do, is they combine companies, so they drive corporate consolidation and monopoly power. And they also suck out a huge amount of public money and put it into the pockets of financial managers. And there are countless examples of problems of what you get with this kind of investment. I won't go into it because Ed is going to talk about what's happening in the healthcare sector. CICTAR also did some great work looking at what happened with the privatization of energy in Colombia, where you got rate hikes, a lack of investment, and then tax invasion when a Canadian private equity firm took over. With housing in Sweden is a good example where you have apartment blocks taken over by Blackstone that are raising rents, deliberately raising rents, skipping on maintenance, and evicting poor tenants so that they can flip those units within a short time frame and make huge profits. And here and in Indonesia, what you get is a newly established sovereign wealth fund, Danantara, which, from all the information we see, is going to be a large-scale private equity fund, essentially. And it's already funding a hugely controversial food estate project that is resulting in massive land grabbing in Papua. So just some thoughts on what we can do to try to put a stop to this. Well, first, as has already been said, we have to be clear that these financial actors depend on public money, workers' wages, and a supportive regulatory environment. They're getting access to this money and public support because of political choices that are made by our governments. Public pension funds were created and often subsidized by certain governments as a way to provide for retirement benefits. But there are alternative ways to provide dignified retirements for everyone, to do so without financialization, and to do so in a way that is much more inclusive, fair, and aligned with the long-term interests of working people. And we can fight for these things, as people are doing in many places around the world right now. And it's similar with sovereign wealth funds. For instance, the Indonesian government is making a political choice to merge all of its state-owned companies into a giant sovereign wealth fund that will operate like a private equity fund and facilitate more corporate investment in things like mining and agriculture. There are alternative ways that Indonesia and other countries can allocate national wealth. Bolivia, just to give one example, is using the proceeds from its gas resources to fund a pension scheme that just pays a direct amount out to every single Bolivian. Governments like the US, UK, and Singapore, who have long made private equity possible by providing special tax laws, are now making it possible for private equity to tap directly into the savings of individuals. This is a really scary development. And these are political choices that are going to fuel even more predatory investment. I'm going to share a chart that Kevin Scarrett, who's on the call here, developed a few years ago. And what we'd like to suggest is that, trying to deal with this situation by pushing for more worker control over pension funds, or by trying to get pensions or sovereign wealth funds to follow some form of sustainable and social criteria, is really unlikely to be effective. The record on this kind of action is quite poor. And when it comes down to it, these funds are not structured in a way that can serve people's needs, right? They invest in privatized water utilities. They're not interested in supporting public water utilities. They're not set up for that. When it comes to food and agriculture, we've seen they invest exclusively in large-scale industrial agriculture. They're not interested and not structured to support small-scale local food systems. And when it comes to actions, we think that we need to focus on, say, this outsider column here, as Kevin has put it. What this means is, first, organizing and mobilizing for universal retirement and social protection systems, as well as public services and infrastructure that are paid through equitable tax laws that avoid financialization completely, that avoid putting people's money in the hands of financial companies. And these struggles can bring together a large cross-section of people, from small farmers and fishers to factory workers and teachers, and importantly, workers in the informal economy who rarely have access to any social protections. And these are the kind of wins that can cut off the flow of money to predatory finance. And secondly, we think we should be taking actions to protect against or impede predatory finance. So this can mean things like exposing and putting pressure on financial actors. It can mean, shining a light, like Kate was saying. It can mean campaigns to scare them away from certain investments, like we've tried to do with farmland, or to divest from Israel, for example. It can also mean supporting affected communities and workers in their fights against predatory investment, and building solidarity between those who are affected by these investments and those whose money is being used to fund it, like workers with pensions. And it can also mean fighting for laws and other measures that impede predatory finance. I'll just give one example. Denmark passed, after a lot of pressure, public pressure from people, passed what is called the Blackstone Law, named after Blackstone, the private equity firm. And what it does is it makes the tactics used by private equity firms, the tactics they use to flip housing, illegal. So it prevents new landlords from raising the rent for 5 years or from offering tenants money to move out. And it had a real quick, effective impact. And we think these are the kind of actions that's where we should be investing our energies. So I'm going to stop there. There's some great presentations to follow, and I'm really looking forward to the conversation today. Thanks, Kartini. Over to you.
Thank you, Devlin. I think you gave a lot of this overview and how some of this public money have been used to, affecting our livelihood basically in many different places. And what we hear also, the fact that some of this source of private equity investments coming from sovereign wealth fund. And we see in the last couple of years, there's really a trend moving forward in many of the governments in Asia Pacific to set up their own sovereign wealth fund. One of them is Philippines, and we have Sonny Africa here from IBON Foundations, who will share more about the Philippines Sovereign Wealth Fund and also what it's sort of doing actually. And so over to you, Sonny.
Hey, is my mic on? Sorry.
Yes, yes,
Good,
we
thanks.
can hear you.
Okay, sorry. Okay, good day, everyone. Thanks very much, Kate, Devlin. I don't know what else to say, but I suppose I'll make the most of it. I think that I was really struck with Devlin's presentation that, it really affirms, wanting to make money really does bring a lot of bad people and bad actors together. My presentation is quite short. It'll be about the Maharlika Sovereign Wealth Fund. That's what they call it. It's a new and still small sovereign wealth fund. So a bit of an overview on that. Secondly, a specific example of how the Maharlika Investment Fund is partnering to make money, loads of money with Thailand's CP Group, specifically an investment in a private equity fund. And third part is our concerns, which is, well, I suppose quite a lot, expectedly. Maybe a little bit of a qualification. The Maharlika Fund and this partnership with Thailand CP Group, they're all quite recent. This is really just in the last few months. So there's really little impact yet. But while it's still quite speculative, we'd like to think that the analysis is informed speculation. It's informed by the context of, kind of confirmed bad political behavior in both countries. Also, I think confirmed bad business behavior in both countries, and already evident risks and vulnerabilities in the existing setup. I chose a sensational title, "Co-mingling Vultures," to try to be evocative, but they're just such bad people. I like the visual of vultures and predatory behavior. Um, so quick overview on the Maharlika Fund. The Maharlika Investment Fund is the Philippines' very first sovereign wealth fund. It was created by law in 2023 and given a seed fund of $1.4 billion. This came from two government banks. And again, no one says they want to do bad things. So the Sovereign Wealth Fund wants to pursue both financial and development returns. You kind of wonder how they can achieve both. Um, the fund is seen to have as much as $9 billion eventually in authorized capital, still tiny, I think, as sovereign wealth funds go. Initial financing is already from public funds, from government banks, from central bank dividends, from government gaming, casino revenues, potentially, if needed, selling government assets, subsidy from the national budget. There's also a provision in the law creating it that the fund can actually borrow on its own sake, um, but covered by the Philippine law of automatic payment of all debts, not even having to go through any sort of fiscal process or regulation. Pension funds, of course, were one of the biggest sources for the seed fund, but they were eventually excluded as a funding source after a very strong public outcry. As it is, the Maharlika Fund is open to funding and investment from the private sector, both domestic and foreign. And as with many gray areas in this whole weird setup, the mechanics of private sector participation are really not clear. What are our main criticisms of the Maharlika Fund as a so-called sovereign wealth fund? It's not a wealth fund because the government does not have a surplus in any way. So it's a completely vanity project on one hand, but also I think quite intentionally a source of corruption. And if you look at how it's set up, it seems to be loaded in that direction. The governance structure is super dubious and really prone to high-level influence, basically corruption from the very top. The president is all powerful in appointing and rejecting board directors. Um, Government officials dominate the board. 5 out of 9 are the majority are government officials, and they're all government officials appointed by the president. There are no controls of any meaning. The whole section of about having controls is really preventive. It's not preventive. It's mostly punitive in terms of fines and penalties. And even some sort of definition of terms as a preventive measure to sort of control the decision making of the board. When the law came out, the implementing rules and regulations were amended to take out those structures and controls. So now, basically, whoever gets on the board can now, with a free hand, come up with the guidelines for the investment, for the all the decision making, and it's not going to be enshrined in law. It's going to be counted as sort of internal rules by the fund. Um, Last major criticism is that it's again, as raised already by Devlin, this won't fund development. And not only will it not fund development projects, it has already started diverting resources from other government agencies with more direct development mandates. The two sources of the seed fund came from the Rural Land Bank of the Philippines, meant to be a rural fund for small farmers, and the Development Bank of the Philippines, meant to be a bank for small enterprises. So it took that out, put it in the Maharlika Fund to be used for no one really knows. Um, Basically, we can conclude it is simply a leverage fund enabled by public fund diversions and borrowings. The whole point is to attract funding from private sources under the justification that it directly or indirectly supports these vague development purposes. What we are sure, again, as Devin already mentioned, it will invest in projects with financial returns, not long-term development gains. That means it will favor ventures driven by private profit. Um, we um, we in the course of discussions on that, there was a lot of questioning on the fund managers. Will they invest in projects with no immediate or direct financial return, but socially important, public hospitals, public schools, or maybe strategic development projects, again with no immediate return, like community irrigation or long gestating industrial projects. There was never a clear answer, and if they couldn't put it in writing, it means they're going to avoid it in practice. Um, Now, the Maharlika Fund was quite new. It was set up in 2023 amid much protest. It finally just got off the ground. Pretty much we can say here in 2025. There are only three investments so far. In January, $338 million was put to buy a 20% stake in a China invested national grid corporation, a transmission project, energy project in the Philippines. In February, $100 million was invested with the Thai CP Group's private equity fund, supposedly $1 billion worth, which we'll be talking about in a few minutes. And the third project was a 76 million investment in a copper gold project with an Australian invested mining corporation, the Makilala Mining Corporation. So that's a broad overview of the Maharlika Fund. I'm going to focus on the second investment in February with the CP Group. The CP Group investment by the Maharlika Fund is the only investment so far in a private equity fund. But we have no idea what that means. The CP Group in the Philippines, I only found out a couple of weeks ago. The CP Group's subsidiary in the Philippines is actually the largest foreign TNC in Philippine agriculture. It's the 113th largest corporation in the country. Um, and from Thailand's perspective, the CP Group investment is the biggest Thai investment in the country. CP's been around since 2007, and it basically has two core business lines spread across the country. There's a livestock section, broiler uh, and swine businesses, and the aquaculture, mainly shrimp and fish. Now, again, as an example of how easy it is for these folks to lie, for many, many years now, they've been claiming that the CP Group has $2 billion in investment in the country and will be adding anywhere from $2 to $2.5 billion more in the coming 5, 6, 7, 8 years. That's a bit absurd because total Thai foreign investment in the country is just actually $878 million. CP's investment is very far from the 2.5 billion they promised. There's only about $179 million investment by the CP Group in the Philippines. Again, these are mostly in shrimp hatcheries, shrimp farms, feed mills, but there are also breeder farms, boiler farms, swine operators, pork slaughterhouses, meat shops, and I'm sure that any Thais on the call will know Chicken Star is also read in the Philippines. One thing we do want to highlight with this whole hype about the $1 billion private equity fund with the Philippines having a more or less 10% stake in that. No one knows anything about it. We have asked formally. We have looked at the website of the Maharlika Fund. We've looked at, stared at the transparency declarations of it, but categorically, there is no information at all about just what exactly the terms of the partnership are with CP. And I think that's going to be my segue to the last part of the input. I'm sorry, I'm running out of time. Um, our basic conclusion is the public money of the Maharlika Fund is going into a private equity fund controlled by the CP Group. This is in effect the use of Filipino public resources to finance projects largely benefiting a foreign conglomerate. Some super basic things are missing. No one knows. We've asked around our media contacts, government contacts, the public websites. No one knows the terms of the partnership of the Maharlika Fund, a public fund, with the CP Group, a private equity fund. We don't know what control the Filipino public has over the CP Group's investment decisions. At 10%, probably not. So the Filipino people have no control over the Maharlika Fund as it is, much less does it have any power over the CP Group's private equity fund. We don't know who controls the CP Group's returns and profit distribution. We have no idea about the mechanisms for oversight and accountability. So setting aside the Maharlika Fund's own internal poor governance structures, we'd be very, very surprised if there are the really strong contractual protections or co-partner status where the Maharlika Fund will have some sort of meaning in the CP Group private equity funds investment decisions and returns. Otherwise, basically, we have so many problems with the Maharlika Fund. This partnership with the CP Group clearly adds another layer of pretty serious governance, development, and financial risks for Filipino public funds. So the terms of that partnership are completely unclear, but our second key criticism is clearly being used for the self-serving purposes of the big Thai capitalists of the CP fund. Um, Conceptually, we're very worried that, this is just another kind of vulture finance strategy where a foreign private firm leverages public resources and risk from Filipino taxpayers' funds for high return, no accountability ventures. At a conceptual level, we're very worried that the Philippines generally has an underdeveloped financial system, but instead of developing it in a more social development direction, what the Philippine government is doing now with the CP Private Equity Fund is that Philippines going further towards a very speculative and financialized development financing rather than real development investment in public systems. Major concern, of course, is where is the development for the Filipino people. There's no evidence the Philippine government has at all required the CP Group to subordinate its own profit seeking to the Filipino public welfare outcomes or whatever Philippine national development strategy is. Conceptually, this really does see development planning to the logic of financial returns and investment rather than social need. If anything, after CP being in the Philippines since 2007 and seeing the kinds of enterprises it has invested in, the Philippine government is actually helping entrench the CP Group in the Philippines, oblivious to how the CP Group's operations actually compete with and crowd out similar Filipino efforts that would be important to develop our own indigenous domestic agriculture capacity. As it is, Philippine agriculture has already fallen to 8% of the economy, which is its smallest share in the country's history. And of course, that's aside from the fact that agribusiness models like the CP groups undermines food sovereignty, reinforces industrial agriculture, and undermines local food systems. Sorry, last major point I want to add is that there is a way forward, but this isn't it. Our proposal is quite straightforward. The Philippine government shouldn't go through the Maharlika Fund, much less should the Maharlika Fund go into supporting a private venture, private equity fund like the CP groups. Our basic proposal is the Philippine government, with what scarce, finite, tiny resources it has, it should directly fund and support public food systems, agroecology, small farmers, and farmer cooperatives. Completely against how increasing the financial power of capitalists is a very bad thing because it increases the destructive power of capitalism. Sorry for going over time there. Thanks.
Thank you, Sonny. That's really great. I think Sonny presentations is again sort of highlight the fact that many of the public money that people are paying through different pension funds or other like rural banks, for example, are being used to actually financing project that will benefit foreign conglomerates. I think the examples of Maharlika is something that the Indonesian governments are currently kind of copying, if I may say so. So it's sort of like segue to our next speakers from Indonesia, Andi Wijaya, who is from Workers' Unions of Indonesian National Electricity Company, Indonesia Power, to talk about some of this privatizations agenda behind the green energy transitions that currently being pushed in the country. Andy will speak in Bahasa Indonesia. So if you want to listen in English, please choose the interpretations English channel. So Andy, I need to remind in like 10 minutes time for each. Sorry, so we have space for the question and answer later. Go ahead, Andy.
Ya, terima kasih Mbak Kartini. Perkenalkan, nama saya Andi Wijaya. Saya saat ini sebagai Sekretaris Jenderal PPIP, Persatuan Pegawai PT PLN Indonesia Power. Kami adalah serikat pekerja yang berada di anak perusahaan dari PLN. PLN adalah state-owned company, BUMN yang dimiliki oleh negara Indonesia khusus untuk bisnis ketenaga listrikan. Kami akan membawakan materi. Apakah sudah terlihat? Oke.
Sudah.
Saya akan membawakan materi dengan judul Energy Transition Agenda for the sake of the world or greediness of oligarchy. Pertama, kalau yang diprivatisasi pada saat itu ada ketenaga listrikan, ada migas, ada minerba, dan ada air yang secara ketenaga berisi liberalisasi dan privatisasi untuk sektor ketenaga listrikan. Bisa dilihat ada 6 undang-undang yang berulang kali kami lakukan judicial review dan dibatalkan, lalu dibuat lagi yang baru, dibatalkan, dibuat lagi yang baru dan dibatalkan, sehingga kami menilai di Indonesia unbundling dan privatisasi ketenaga listrikan itu seperti zombie yang dimana dia mati lalu dihidupkan kembali, mati dihidupkan kembali, mati dihidupkan kembali.
It seems and disconnect. Now you're back. Andy, you're on mute.
Maaf, tidak tahu kenapa, saya terlempar. Balik lagi, ketenaga listrikan di Indonesia itu seperti zombie yang hidup terus-menerus. Kemudian kita masuk ke background energi transisi. Kita sama-sama tahu dimulai di tahun 92 UNFCCC, lalu dikonkretkan di Paris Agreement, COP21 Paris tahun 2015. Dan yang terakhir, kita sudah sama-sama menyepakati bahwa tahun 2050 kita akan memasuki net zero emission. Ini adalah dokumen Paris Agreement yang di Indonesia diterjemahkan menjadi Indonesia berkomitmen pada tahun 2023, pada tahun 2025 bahwa energi terbarukan kami itu akan mencapai 23%. Sayangnya di tahun 2023, 2 tahun yang lalu itu diturunkan targetnya dari 23 ke 17%. Lalu yang kedua, Indonesia adalah salah satu negara yang menjadi percontohan JETP, di mana kami dijanjikan uang sebesar 20 miliar US dollar, tetapi hanya 130 juta US dollar yang bentuknya grant, sedangkan yang lainnya itu loan atau debt. Lalu kita masuk kondisi ketenagalistrikan di Indonesia. Ini berdasarkan data tahun 2022 bahwa Indonesia sudah rasio elektrifikasinya 99,63%, artinya hampir sebagian besar, bahkan sangat besar daerah di Indonesia yang sudah terlistriki. Kemudian kita punya data lagi di tahun 2023, inilah negara-negara penghasil karbon dioksida terbesar di dunia. Kalau kita lihat, Indonesia adalah nomor 5. Tetapi Indonesia hanya menyumbang 6% dari Cina. Jadi Cina 11.218 karbon dioksid, sedangkan kita hanya 700, kita hanya 6% dari yang dihasilkan Cina. Dan kalau kita melihat dunia, maka apabila emisi dihentikan di satu negara, tetapi dihasilkan di tempat lain, maka climate change tidak akan berubah, akan seperti ini. Sayangnya, data menunjukkan bahwa tahun ke tahun yang terjadi bukan energi transisi, tapi energi expansion. Kita lihat pemakaian coal itu makin meningkat dari tahun ke tahun, pemakaian oil meningkat, pemakaian natural gas meningkat. Sedangkan energi baru terbarukan, ini sangat kecil peningkatannya. Sekali lagi, kita bukan masuk ke energi transisi, tapi energi expansion. Dan kalau kita melihat, Indonesia sebagian besarnya memproduksi batu bara dan kemudian menjualnya. Hampir 75% produksi batu bara Indonesia itu ditujukan untuk ekspor. Terbesar dibeli oleh Cina, lalu India, dan kemudian bertahap-tahap negara-negara yang lainnya. Ini adalah mix energi Indonesia tahun 2021. Kami punya batu bara 63,52%, panas bumi 5,63%, gas 18%, yang lainnya kecil. Inilah tahun 2021. Tahun ini kami mendata persentase batu bara meningkat di angka 68% karena program 35.000 MW Indonesia. Ini kondisi Indonesia, kalau kita lebih skop kecil lagi, tahun 2022 Indonesia mempunyai kondisi oversupply. Lalu mix energinya, energi terbarukannya cuma 13,5, batu baranya 63,5. Dan ini kalau kita perbandingan harga jual PLN dan swasta atau IPP, Independent Power Producer, swasta Independent Power Producer menjual 36% lebih mahal. Ini untuk perbandingan dengan energi primer yang sama, yaitu batu bara. Dan ini kami capture tahun 2023, pada saat itu langit Jakarta sangat hitam dan terpengaruh oleh polusi. Tetapi pada saat yang sama kita mematikan pembangkit terbesar kita 1.600 MW batu bara yang berada di Banten, tetapi langitnya tetap hitam. Berdasarkan data Dinas Lingkungan Hidup, hampir 73% dihasilkan oleh pabrik dan transportasi. Inilah yang dibuat Indonesia dalam menjalankan energi baru terbarukan. Di General Plan for Electricity Supply yang diterjemahkan ke dalam RUPTL, ini adalah kondisi 2021, di mana yang hijau ini adalah energi baru terbarukan, Sedangkan yang biru ini adalah fosil dengan coal-nya ada 63%. Dan kita di perencanaan 2030 dirubah yang tadinya fosil 51, KBRG 48,4 dan coal-nya menurun 34. Inilah gambaran dari energi baru terbarukan, itu merupakan porsinya swasta atau IPP. Jadi Indonesia melakukan transisi energi dengan memberikan porsi perubahan transisi energinya kepada swasta atau IPP. Apa yang menyebabkan itu berbahaya bagi negara Indonesia? Jadi kalau kita melihat komponen PLN, maka PLN itu mendapat kompensasi dan subsidi dari negara dari tahun ke tahun meningkat. Kita lihat di sisi sebelah kanan, kita perbandingkan antara total subsidi dan kompensasi yang diterima oleh negara dengan PLN yang membayar listrik kepada swasta. Maka kita lihat dari tahun daripada bagaimana PLN membeli. Misalnya kita terus-menerus memberikan porsi ketenagalistrikan kita kepada swasta. Ini akan meningkat terus dan akhirnya akan membebankan masyarakat. Memang Indonesia dari 6 tahun yang lalu belum mengalami kenaikan harga jual listrik ke masyarakat. Tetapi subsidi dan kompensasi dari negara dari tahun ke tahun meningkat. Tahun 2024 kami perkirakan kompensasi dan subsidi yang diberikan negara akan naik ke angka 160 triliun. Ini summary laporan keuangan dan laporan statistiknya PLN. Kalau kita lihat dari tahun ke tahun 2000 sampai 2023, porsi PLN memproduksi sendiri itu turun dari 69% ke 56,9%. Dan porsi jual swasta ke PLN meningkat dari 30% menjadi 43,1%. Nah, dampak kenaikan swasta itu dikompensasi dalam naiknya subsidi dan kompensasi negara kepada PLN. Dan kalau misalnya ini tidak diberikan oleh PLN, maka secara agregat listrik yang dibayarkan oleh masyarakat kepada PLN itu akan meningkat, kami estimasi 52% di tahun 2023. Jadi ketika tidak ada subsidi sebesar 142,6 triliun di tahun 2023, maka PLN harus menaikkan harga jual ke masyarakat sebesar 52%. Ini bagaimana kami memandang transisi energi seharusnya diterapkan di Indonesia. Pertama, transisi energi tidak boleh bertentangan dengan konstitusi Indonesia, terutama pasal 33 ayat 2 dan 3 yang menegaskan tidak ada unbundling dan no privatisation, atau berdasarkan putusan MK itu wajib dikuasai oleh negara atau berada di tangan publik. Terus yang kedua, transisi energi harus memastikan affordable selling price atau harga jual yang terjangkau oleh masyarakat. Dan yang ketiga, transisi energi harus memastikan safety to consumer and environment, harus memastikan itu aman bagi lingkungan dan juga pelanggan. Inilah bagaimana kami perjuangkan dan kami memandang transisi energi harusnya dilakukan di Indonesia. Terakhir, dari waktu ke waktu privatisasi adalah alat bagi keserakahan oligarki yang akan terus berganti metodenya. Tetapi kita akan dan kita harus bersiap dan tetap harus bersatu untuk memperjuangkan privatisasi tidak boleh diterapkan di negara manapun. Karena pada dasarnya listrik adalah kebutuhan dasar bagi umat manusia. Dan juga listrik itu sangat dibutuhkan. Kita lihat kondisi terakhir di Portugal, Spanyol ketika mati listrik hampir 1 hari penuh karena ditengarai ada serangan cyber, itu melumpuhkan satu negara. Itulah pentingnya listrik dan kita harus memastikan tidak ada privatisasi. Terima kasih banyak, muchas gracias, merci beaucoup, muito obrigado, tesektur Edrin, dan terima kasih. Itu presentasi saya. Tetapi sebagai penutup, Indonesia saat ini juga sedang membuat satu sovereign wealth fund yang memasukkan seluruh aset BUMN, state-owned company, ke dalam apa yang disebut Danantara. Danantara itu mirip dengan yang di Filipina, yang diinformasikan oleh Brother Sony. Tetapi kalau Brother Sony melihatnya sovereign wealth fund itu untuk investasi di luar, kami melihat bahwa Danantara itu menjadikan aset-aset BUMN sebagai agunan dan meraih investasi dari luar untuk membangun Indonesia. Artinya bagi Indonesia akan lebih banyak hutang dan akan lebih banyak persyaratan-persyaratan yang akan menghilangkan public service di Indonesia dan akan merugikan rakyat Indonesia. Demikian dari saya, terima kasih banyak dan sekali lagi terima kasih.
Terima kasih banyak Pak Andi sharingnya.
Kartini, you are muted.
Sorry. Sorry, just to continue from Andy's presentations that he already shared, how a lot of this privatization push into, essential public sector. I would like to invite Ed Miller from CICTAR to speak further about the private equity that creeping into this renewable energy development, as well as other important sector like healthcare in Asia. Ed is a researcher from Center for International Corporate Tax and Accountability Research and based in Aotearoa, New Zealand. Ed, the floor is yours.
Thank you very much, and a huge thank you for all the speakers so far. It's been a really illuminating discussion. Hopefully, this will help build on some of those discussions as well. I'm going to talk a little bit about what private equity is. We'll move through that kind of quickly because a lot of it was covered by Devlin and also the other speakers. And then we're going to look at the movement of private equity into the Asia Pacific region in particular, and then the movement into the health and renewable energy sectors, and how private equity is trying to sort of suck up all the benefits of development and make sure as much as possible goes into the back pocket of large investors and as little driving quality public services and development outcomes that we need so desperately in our Asia Pacific region. So I'm going to start with this little bit of introduction on private equity. I'll move through this kind of quickly. The trend really began unfolding in the 1980s in the US, particularly under the Reagan administration, when we saw quite radical deregulation of financial markets, which enabled a trend of what we called leverage buyouts, which was a change in how the ownership of companies or how wealthy people owned companies. A leverage buyout is a kind of acquisition of a company which is largely debt funded. So these private equity funds would borrow a lot from other investors and sink that money into particular companies. They would try and take controlling stakes in the companies. So sometimes we're talking 100%, sometimes it's 50.1%. Enough that they could control those companies and then take them private, so remove them from the stock market if they were listed on a stock market. And one of the key points about the key reasons for taking companies private is because private companies have much lower transparency requirements or reporting requirements, which means that The private equity funds themselves were able to make the kind of radical changes to those companies that you wouldn't be able to do as easily with with public companies that are listed on share markets. The common approach then was to take those companies and restructure them so that they were radically focused on maximizing returns. So what that meant was they would break them up into little pieces, sell off the non-profitable assets, lay off large numbers of workers, other kinds of changes to working conditions, all sorts of changes to drive the maximum returns as quickly as possible, and then with the objective of trying to achieve to exit the company, to own just for a number of years, make the changes as radically as possible to drive that profitability, then exit with a large pile of cash. So unlike listed companies that tend to pay out profits as dividends to their shareholders as regular cash payments on an annual basis, these companies generally behave by starting with an amount of money, holding on to the company while they restructure for a couple of years, then exiting out the other end with a big pile of cash to distribute back to their shareholders. The most kind of legendary example of this, or maybe the symbolic beginning of the private equity period, is the example that I've got above. It's when a big private equity fund, probably one of the largest on the planet, called KKR, bought a company called Nabisco, the old American National Biscuit Company, which was a large conglomerate, had a large number of interests across different markets in the food, beverage, and tobacco sectors. The KKR got together a huge amount of investment capital. This was in 1988. They got $25 billion together, and they were able to buy this company, Nabisco, which they cut up into little pieces. They sold off all the non-profitable parts of the company to various different investors. They laid off thousands of workers, and one study by the US Department of Labor noted that even though they laid off thousands of workers, around about 70% of those workers ended up being rehired or replaced with other workers, but they were replaced with workers on incomes that were non-union and maybe at levels well below what they'd been earning before, some of them less than half of what they had been earning. 3 years later, they sold the company for a significant profit, and it was again floated on the share market. So that's kind of a standard private equity play, if you like. We've talked a bit about the role of pension funds and sovereign wealth funds. I think some important things to add here is that even though we talk about pension funds, which we think of as being workers' capital, pension funds themselves are very unequally distributed. And by and large, we are talking about the savings of the mega rich who are the large beneficiaries of pension funds, and low-paid workers who have small amounts end up being taken along for the ride of being in these really damaging kind of investments. Similar with sovereign wealth funds, there's a real trend, we've heard about it today, about countries across the world establishing sovereign wealth funds. But again, most of the sovereign wealth funds are with countries that operate large surpluses. We're talking about petrostates by and large, who are able to reinvest the profits of natural resource extraction into these investments. One example of that I've got a picture of above is when a private equity fund called GIP, Global Infrastructure Partners, which is owned by BlackRock, which you probably all know a little bit about, a $10 trillion asset manager, acquired the Gatwick Airport in London with money from the California Public Employees Retirement System, so Californian employee savings, and the Abu Dhabi Investment Authority in 2009. Private equity funds tend to love investments like the Gatwick Airport, or airports in particular, because they tend to be monopoly assets, right? There's no real competition in the marketplace, so they can jack up costs, jack up profits, jack up the prices as much as possible, and pull out all the costs as well to maximize returns to their shareholders. Private equity also got a really big kick from the global financial crisis, when a lot of investors lost faith in the big banks to become to manage their wealth, and started shifting their money into private equity forms of investment. We saw private equity start to move into Asia in the wake of the Asian financial crisis. So kind of at the end of 1998, 1999, where a lot of distressed assets, so companies who'd had serious damage to their market value, were desperate for capital injections. One example of this is in 1999, a consortium called Newbridge Capital that was led by a private equity fund called TPG, the Texas Pacific Group, acquired Korea First Bank. So South Korea was badly affected by the Asian financial crisis, and they were able to acquire that asset for very cheap. They entered into this investment and they reoriented the investments of Korea First Bank. So instead of focusing on their traditional role of supporting the chaebol, which are big investment conglomerates that have had a major role in the development, the economic development of Korea, they shifted towards retail banking. And then after 5 years, in 2005, they sold their majority stake to Standard Chartered, the big British bank, for $3.3 billion, and in the process earned a $1 billion profit in a very short 5-year space of time. There was significant public controversy about this whole episode in Korea, not least of all because of the role of foreign investors in making windfall returns from the ownership of Korean banks and Korean investments. But it was also later revealed that through tax audits by Korean authorities that Newbridge Capital had used very aggressive forms of tax planning and were able to take most of that $1 billion profit with minimal tax payments in the process. Another kind of similar example is the acquisition by, again, our good friends at TPG, ironically, who were able to acquire Hyundai Logistics and turn that around, quote unquote, turn around the company, which they achieved by substantial layoffs of workers before they exited that company with a large profit. Private equity started moving into healthcare in the 2000s. Healthcare was really attractive to private equity because it gets large amounts of funding, both public funding and also private funding, largely through insurance contributions. In 2006, there was a deal involving a number of private equity funds, some that we've already heard from, and you'll notice that there's actually not that many players in this game. Bain Capital, KKR again, that was responsible for the Nabisco buyout, and Merrill Lynch, which is kind of an example of a traditional bank moving into the private equity space. They acquired Hospital Corporation of America for $33 billion in a large buyout, the largest in healthcare at the time by a long way. After acquiring the company, they slashed employment levels, and there was a significant decrease in capital investment throughout the hospitals that they owned. They paid large dividends to themselves, so slightly unusual in a private equity context. And then they floated the company in 2011 and sold out their shareholdings. According to one estimate, there was a tripling of the investment made by the private equity companies involved after the sale of the Hospital Corporation of America. So really large, damaging kind of buyout process. Healthcare is also attractive to private equity companies because you have lots of different subsectors within it. So you have your primary care, dental care, ophthalmology, diagnostic, all these different subsectors. So it's a fragmented marketplace. And that allows private equity funds to go through and try and corner the successive markets with a thing that's called a roll-up strategy, where you move into the market and then buy up a whole bunch of smaller firms until you have a really large stake in that market. So it doesn't attract the interest of competition regulators because no single transaction is a large reduction in competition. But by slowly buying up all of those competitors, you end up with market power and able to set prices and indeed to lower the level of investment right across the industry. Another reason that healthcare is of a large interest to private equity is that healthcare historically has been developed by the public sector and has accumulated a lot of underlying real estate. So each hospital sits on some land, and what private equity funds often do is enter into what are called a sale and leaseback agreement, where they sell the real estate or sell the hospital and the land itself to another property fund, and then they lease that land back. And by doing that, they generate a whole bunch of cash at the first instance, and they can use that either to reward their investors or to buy up lots of smaller companies in the market and get ready for that exit of the market with a big bundle of cash. One current example that we're dealing with is the acquisition of Healthscope in Australia, which was the second largest private hospital operator in Australia by Brookfield, a big, large Canadian asset management fund that has a major private equity wing. And much of the acquisition itself was funded by the sale of those hospitals at the first instance. So you can see that sometimes you don't actually even need that much capital going into these deals if you have a strategy for being able to generate that by selling off assets, which is what we saw in the Healthscope example. We've seen this movement into public services being kind of, if you like, impact washed by
Looks like Ed, are you still there?
Sorry, my connection must have fallen out. I'll just share my screen again. Sorry about that.
You have 2 minutes maximum.
But I'm going to move really
Yes.
quickly then. Impact investment is effectively a way of whitewashing the investment by saying that you're looking at metrics beyond just financial metrics, but the idea is trying to use investments in public service to attract other forms of investment. Development finance has been a major player in the impact investment space, and it's helped to de-risk that investment for private sector players trying to move in there. I'm not going to talk about that example, even though it's a really spicy one. We're just going to keep moving on to private equity in Asia. Private equity has really been interested in Asian healthcare because you see these growing middle classes emerging. And there's a lot of private health insurance that is stepping in. There's a real interest in private health insurance and investment there. That's partly being pushed by the underfunding that exists in public health sectors, which is a problem that's not just limited to Asia, the poorer countries in Asia, if you like, but actually exists right across the Asia Pacific region, including here in New Zealand as well. I won't talk about these deals in too much detail because we're running out of time. But again, that de-risking role of development finance is a really important one in the healthcare space. And then moving into renewable energy, there's a long history of development finance institutions in renewable energy, from the World Bank building a dam, moving into the World Bank building gas plants, and now places like institutions like the IFC that are really getting into the renewable energy space. There's huge demand for renewable energy in the Asia Pacific region, and private equity is really moving into this space. But the one thing that I will mention is that private equity will only invest where there's profits to be made. Therefore, in a sector like renewable energy, which is the cheapest energy that we've ever had on the planet, they are relying on having either very expensive fossil energy set the price for renewable energy so they can generate windfall returns, or having state subsidies to make sure to bolster those profits and make sure that they can exit with large amounts of cash after a couple of years. Very quickly, just a few things I wanted to say to wrap up is that private equity is an aggressive form investment strategy, but it is a short-term one, and that well-organized unions or other social groups, environmental groups and so forth, can repel and resist that. If you're a problem that needs to be managed by private equity, if you make your presence known sufficiently loudly, then they will have to accommodate to your demands, and they will probably leave if you can make enough of a problem for them. So it's really important that we meet them proactively, that we make our presence known from the outset, that we understand their strategies, we fully research what they're trying to do. We're building horizontal coalitions between other people that are affected by the same kinds of investments. And at the same time as engaging and campaigning, we're working in political coalitions to try and push for regulatory reform, particularly to regulate private equity and make it as transparent as other forms of investment, and fundamentally to ensure that we have public ownership of our public services and other assets. Thank you very much.
Thank you, Edward. We're a bit running out of time, but I think what Edward says at the end, it's really important to note that well-organized unions or groups have the capacity to really repel this this dominant power that existing today. Maybe I open the floor for a few questions if anyone wants to have comments or questions on this speakers. We haven't seen anyone post on the chat, but if you want to raise your hand, feel free to do so. But meantime, if no one's yet there, I would like to invite Kevin Scarrett from the Financializations Lab of Carleton University, Canada. He's joining us here very late there in Canada, Kevin, to share a little bit about this efforts on resisting pension fund capitalisms that we've been hearing, how pension fund plays a lot of role. Go ahead, Kevin.
Thank you. Excuse me. Thank you very much, Kartini, and to all the presenters. It's a real honor to be here. It's a fantastic package of presentations. I'm just going to say very briefly, I feel very, very good about joining this session. I'm familiar with some of the research and the presenters, but not all of them. So it's been great to hear this information about private equity and these funds, aggressive vulture funds in Asia. I guess what I would like to share just briefly, I know we're short on time, is I think this research and this work that's being done is very important. What I'm involved in Canada is an effort to track and research exactly these dynamics, really globally, but with some focus on Canadian pension funds and large pension funds in the global north. And excuse me, we are featuring that work, as Kartini said, at this new website of the Financialisation Lab, which we have established at Carleton University in Ottawa. That's where I'm based now after my work in the labor movement. So I invite, this is still a very new website. It's limited so far, but we have plans. This is part of one of the things that I'm involved in with the lab is a collaboration with Grain, who's represented here by Devlin, and other partners like PSI, Public Services International, on something called the Resisting Pension Fund Capitalism project, which is also featured on this lab. It's not just pension funds, but pension funds really are an important center of this problem. And I guess the one point I will add is because of the involvement of workers and trade unions, I think the predatory role of pension funds poses a real difficult political problem for workers, for unions, for social movement actors, because many of our own organizations understandably feel a contradictory relationship with these pension funds. Many pension plans are designed with a dependence on the rate of return that's earned by these funds. So we may not like how the returns are generated, but the returns are needed. This is a contradiction, a kind of social, political contradiction that, frankly, I think those of us connected to the labor movement and workers' movements generally have to figure out how to deal with. And so anyway, I'm going to stop there. The dialogue, the debate, I hope to be involved in. And I'm really encouraged by a session like this, the research, the engagement, the obvious interest and the seriousness. I feel like even though this problem is growing, I feel like the resistance, the recognition, and the willingness to really take this on as a problem is also growing. So I feel very good to be a part of this session, and I want to thank all the organizers and presenters. It was really good.
Thanks a lot, Kevin. I think in the chat there's also some discussions going on. The fact that many of the informations around private equity is really difficult not to access. It's a lot of, oftentimes they're not make their financial reports public, for instance. But also, what I think the process that we have today is really to work together to support our efforts really in sort of like building this more progressive collective knowledge and push back against this vulture finance. I think if you kind of interested to further follow up the discussions and to keep informed of these events and discussions around this, as Kevin mentioned, this is really a website project that we've developed together on the Resisting Pension Fund Capitalism. Is really a space also to kind of foster this knowledge sharing and this movement building actually among groups in global north and south, and see how we can push back. So I think I didn't see anyone asking questions. I
Yeah,
hope this
there's a
has
question,
been
Kartini. Yeah, sorry. There's a question
useful.
asking for
One
successful
question's from
examples.
Toby. Yes. Anyone collecting or recording examples of successful oppositions to specific private equities buyout? Maybe Edward or Kevin, you have something. Edward, maybe you have an examples around successful oppositions on specific private equity buyouts. Toby Quattrell.
Yeah, one group that I know that's doing really great work in this space is a group called the Private Equity Stakeholder Project. They're not necessarily only focused on successful outcomes, but they are trying to document the impact of private equity and trying to work out who the stakeholders are and magnify their efforts and try and work out exactly what the playbook is, both from the private equity side and in terms of what the successful playbook should be for us in responding to private equity. So that's one group that I think is really worth following, the Private Equity Stakeholder Group and or Stakeholder Project. And then if I could just plug our own organization, CICTAR, the Center for International Corporate Tax Accountability and Research. We're doing lots of work on lots of different private equity engagement in different sectors, and we'd love to work with any other stakeholders who have a real interest in fighting back against this, because we're not going to be able to do it alone.
I hope that answered the questions. So I'm afraid we have to close the sessions. There's one
Sorry,
more.
Kartini.
Yeah, go ahead, Kate.
Yeah, sorry. Well, first of all, I was just going to, because there's this question from Sunny about, getting information and so forth. And maybe Jason or Ed want to jump in, but just as I mentioned earlier, because there's been some improvements in reporting in Australia on more, this is large corporations. I think Jason might have some comments on that. In the future, there'll be more availability of data that can be shared, and perhaps we'll organise a webinar in the future for CICTAR to help other social movements and affiliates better understand how to use that information. I know that they've already got a little bit, but I think that'll be helpful. So that's one thing. And the other, it reminded me that there was a movement to stop BlackRock from sponsoring different UN agencies. They were, I think one of them was with UN Women, so it was called the BlackRock group, and that was a success. So they were trying to, I guess, pink wash all their harmful activities. So there are groups that are specifically trying to stop different private equity groups in having that influence even over the UN. Another group we're in, which is looking at the way in which the UN itself is being corporatized, has been tracking a bit of that. Yeah, thanks.
Great. Thanks a lot, Kate, for reminding us that some of this private equity also involve a lot in the UN sphere. So that's also a space where we need to monitor. With that, I'd like to thank PSI, especially Jyotsna, for hosting the event, the translator, Dina Septi, and PSI Indonesia, all the presenters, and we'll make recording of this event publicized later on. For those who can't join, I think we have more registered than attended here. But thank you, everyone, and we'll continue in other forums. Bye-bye, everyone.
Thanks, Kartini.
Bye.
Thank
Thank you, everyone.
Bye.
Bye-bye. Thanks,
Awesome.
Kate, Devlin, Angus, Edward.
You too.
Bye.
Thanks, Jayo, so much. Thank you for all the work you put into this.
Great. It's my pleasure.
Bye.
Terima kasih, Andy.